Right, it's 11 o'clock as we'll get going. Thanks so much for tuning in again. There's not an awful lot of news this week, actually, so we'll probably get through to our guest quite quickly. But we're going to be talking to Rob Guest, who's the manager, one of the managers of Foresight Sustainable Forestry. It's a new fund, and I think it's quite sort of interesting and different things. So hopefully you've got some questions to ask him. News-wise, just a couple of things that I pulled out. Both of them had results this week. And both of them did quite well, and I thought it would just be worth having a closer look. And they're not funds that we've talked about much, really, over the years. NBPrivateEquity has actually had a very good track record, as you can see here. This is going back 10 years. And for the most part, it's traded at a reasonably wide discount, as you can see from the chart below. And that seems to be widening at the moment, and that's one of the things I thought we'd have a look at. If I show you the context of the wider sector, so 740 million quid is not bad size for a fund. It actually makes it sort of about middle ranking in this group. Just shows you how big some of these things are. And the discount now, 29.7, is really getting quite wide. It pays a dividend based on 3% of NAV, and that actually puts it towards the high yielding end of this peer group. There's a few other funds do something similar, but it's one of the, so it ranks fifth. And then, so the perennial problem with all these funds, so the ongoing charges are relatively high, so about 2%. But remember that all performance funds I'm going to show you are after those charges have come off. So here are the returns, and actually they're pretty good. If you go back over 10 years in share price and NAV terms, it's like third out of 16. And I think that's one of the reasons why I thought I wanted to mention it, really, is just to sort of highlight it if you hadn't picked up on this, that it has been doing quite well. It dates back to 2009, so it's only about sort of 13 years old. It's unusual because it's a split cap trust, in that it's got 0 dividend preference shares. No other way, but it does. One of those matures in September this year. I'm thinking that they may actually consider issuing another round of zeros when that matures. So we will look out for that. Both of them are pretty well covered, and so they trade on relatively low gross redemption yields. The 24 one is about sort of 4.3%, 4.4%, something like that. The NBPrivateEquity team is quite big and global. So I think they've got 11 offices and 150 professional investment personnel. The way that the fund works, it's mostly direct co-investments. So that's 91% of the portfolio. It also has a kind of income portfolio, which it helps to generate some of the income that it is paying out through the NAV. And that's a lot sort of debt, medicine, income, that sort of stuff. Question, how are 0 dividend preference shares issued? From Tim. That will be a prospectus in the same way as we would normal kind of share issue. So they'll flag it well in advance, and there should be an opportunity for all the investors to invest down the line, and they'll have the details then when that happens. The returns, as I said, are pretty good. You can see there, so the gross internal rate return on the equity investments, 22.6% on average every year for 5 years. And one of the things that I keep banging on about is how conservative these NAVs are. So again, on average, every time they make a realization, it's at a 44% higher valuation than the valuation that they're holding out in the NAV. And then again, on average, they're making 2.9 times the money when they're exiting things as well. Last year was a particularly good year. It was a good year for realizations. It was a good year in markets, and that's what helped propel the NAV higher. It also saw some narrowing in the discount, which has reversed a bit since. So shareholders did really well last year, but that will have come down again. This is the split of the portfolio by sector. And again, as is common with a lot of these private equity funds, it is quite sort of healthcare, tech type, consumer related, so that they're not investing in boring old industries. These are exciting companies for the most part. And one of the things, though, that NB does. Here's actually the split of the companies. So you can see that there's 95 companies, average age of about 3.4 years. Some of the big ones, this is listed now, AutoStore, and a few of the other ones are too, but it's a real spread of things. One of the things that they have consciously tried to do is to have a mix of fairly defensive cash generative businesses, which are these ones down this end, and then long-term secular growth stocks, so things like the software companies and the like. Obviously, we know that in the listed market, these are the things that are selling off quite hard, and so that does mean that that's going to be pushing its NAV down. So in 2021, that portfolio, on average, the underlying companies were delivering 27% revenue growth and 28% profit growth because of earnings before interest, tax, depreciation, amortization, EBITDA. That's obviously not bad going. And they're valued there at the end of 21 on 17.4 times EV/EBITDA. They're not too levered, so it's not all about pumping the portfolio full of debt. So 5.2 times debt to EBITDA. And that does mean that they're going to be able to service that debt, I should think, even with rising rates. What's happening in 22 so far, though, the NAV's come down 3%, but that only reflects the moves in the listed positions. So things like the AutoStore thing that we highlighted before. The private equity investments are still valued as they were at the end of December. So that NAV is going to come down. And it is worth bearing that in mind for all these private companies. A lot of them will be in that sort of position. They are still making exits, though, and I think that's maybe encouraging. They don't need to sell through IPOs. They can just sell to other private equity funds. And the other thing we know about private equity industry is that it's got an awful lot of cash, what they call dry powder. They've been raising huge amounts of money over the past few years, and they've got to invest that at some point. So there'll be opportunities to invest that at slightly lower valuations, which is obviously good for some of these companies, but we should still see some exits. The fund has still got $400 million worth of available liquidity if it wants to make new investments over the coming year. So I think they'll be looking to pick up some bargains as we go. So that's NBPrivateEquity. Now, VietnamEnterprise, this is a fund that's been around for a very long time. It's only been listed in London since 2016. It's a big, experienced team based on the ground in Vietnam. The fees are quite chunky. I think, to my mind, that's one of the sort of few negatives of this fund. 1.85 on an equity fund. For the most part, 1.25 billion is really quite big. And so I think there's scope for those to come down. But again, as we talked about the NB one, the returns in 2001 were actually very good. So it beat its benchmark by 8% and delivered 47% in terms of NAV total return. But it also has a discount problem, and it's been buying back shares. So $33 million worth of shares bought back over 2021. An attempt to try and tackle that, but it isn't really working yet. Here, actually, you can see that. You can see how the NAV relative to the share price has been widening, and you can see the discount down here, getting around at sort of 20%-ish. I don't really understand the logic of that, given how well it's doing and how well Vietnam is likely to do. I think this is too wide. Now, the one that we jump up and down about quite a lot is Vietnam Holding, and with good reason. You can see that is by far the best performing of these funds now over most time periods. It's definitely over the past year. And again, its discount's too wide, as we'll see there, 15.1. But all of these things are just way too wide. There is some noise in the market around now. We'll talk about that in a minute, which may be depressing in the short term, but I think that should go away. So these things, to me, look like bargains. This is the big fund, VietnamEnterprise. As I say, it's the sort of flagship fund for Vietnam. It has been for a long time. Last year in Vietnam, they had a sort of change of heart. And this is sort of the sort of thing that the Chinese authorities must be thinking about now. So they'd had a policy from the start of COVID that they were very, very good at just basically making sure there were no cases in the country. And for a long time, there were no cases, there were no deaths. And then I guess Delta and Omicron came along and the whole thing started to fall apart. They ended up imposing a 5-month-long lockdown, and that was a big hit to the economy in 2021. And I think they realized that they couldn't sustain this. So they really went to town on vaccinating people, and now almost the entire population is fully vaccinated, and they're busy now giving everybody booster shots. So they reckon there'll be 98.7% of the population will have had a booster shot by the end of June. So because of the lockdown, GDP was depressed, but it still grew. And I think that again is testament for how fast this country's growing. So up 2.6, mainly driven by the manufacturing sector. And one of the things that's really transformed Vietnam over the past decade or so has been the growth in manufacturing. Really, a lot of people have taken business that was in China and moved it to Vietnam, just because obviously the labour force is a bit cheaper, but also they thought it was a good idea to kind of diversify where they were manufacturing things because of what was going on in China with lockdowns and stuff. And that may be accelerated by what's going on in China now. So the GDP growth forecast is sort of 6.5% for 2022. It may even beat that. It's got a trade surplus, which is very good for the currency. And they're seeing a lot of foreign investment, which is also good for the currency. And one of the things that they're really pushing on is making the stock market a bit more like a normal stock market. So there's long been this issue with foreigners not being able to own more than a certain percentage of stocks, and they're sorting that out. But liquidity is rising, and they're making the whole thing much more efficient from a sort of digitization point of view. So it's much easier to kind of onboard new clients, and they're moving to T+0 in terms of settlement. All of that is gradually shifting the status of the market towards one where I think it should definitely move from being a frontier to an emerging market in the sort of relatively near future. But I think it could be towards the top end of emerging markets before too long, the way it's going. It's not expensive. This is taken from the VietnamEnterprise results, so this is recent. And you can see, like on a PE basis here, just 10.5 times for the market, despite the fact you've got 25% earnings growth. This really is a cheap market. This PEG ratio of 0.4 is very low. Doesn't throw off much in the way of yield, but that's maybe to be expected, just because of the sort of dynamic growth what's going on here, the need to constantly invest. This is what the portfolio looks like. And it's a right mix of stuff, sort of banking. But the largest thing there, how far, is a steel company. And normally you go, steel, not the sort of thing you want to be invested in. This is trading, I think, on 6 times earnings and throwing off huge amounts of cash. And the amount of construction that's going on in the country just means that it's got an order book way out. So it's doing very well. And it probably will continue to do so, I think. But then it's a mix of financials, consumer stuff like mobile phones here, really just geared into this growth in the economy. And I think they're doing a good job of capturing that. It's fairly big portfolio, but relatively concentrated in this kind of top 10. Then this week, the Vietnamese index dropped on Monday by about 5%, which is one of the biggest one-day falls it's had for over 2 years. And Vietnam Opportunity, so not Enterprise, the Opportunity and Competing Fund, actually published something on the 26th just to say what they thought was going on, noting that the market's dropped by 13% so far this year. So the government are going after a number of fairly high-profile fraud cases, and they've made some arrests. And stocks that were affected have been hit quite hard, and speculative investors have been flooding out the economy and about the stock market. And this is local speculative investors, and that's been hitting things. So that hasn't affected the portfolios of these 3 funds to the same extent it's been affecting the market. There are obviously inflation fears still. and the disruption from the Chinese lockdowns, because obviously if you can't take stuff out of China because the port in Shanghai is shut, then that means you can't get components into Vietnam to make stuff. I mean, and then that's a real problem in some cases. But this should be temporary. And as I said before, these things are still quite cheap. So it's trading a long way below its 5-year average. So I think we may be nearing the point where it makes sense to think about this as a buying opportunity for these funds. And of course, we'd say buy Vietnam Holding first, because it's been the best performing one, but let you make your own decisions. That's enough for me. I've actually waffled on longer than I thought I would.